Well, good afternoon, everyone. Welcome to the National REIA update today on October the 15th. Halloween right around the corner. Hope everybody's got their costumes figured out for this year. It's funny because I walked into my lobby of my building today and they got the ladder and the handy guys they're hanging ghosts everywhere and stuff. So hope everybody's going to be festive for Halloween. We'll let just about another minute, just make sure that everybody has time to go ahead and sign on in and be let in from the waiting room before we get started. Okay, looks like everybody is pretty much here. Well, we have some special guests today. I'm going to let Rebecca announce those special guests and some other announcements before we get started. So I'm going to turn it over to our Executive Director, Rebecca McLean.
Thank you, Ron. I really appreciate it. And thank you to those that are with us today for the REIA Now update for this month. We have Ryan with us. Charles Tassell will be talking about legislative affairs. And then we're excited to have Eddie Speed and Brian Lauchner with us to do part two, basically, of the session that we did in August about bad debt and non-performing notes. So we're very excited to hear from them because I know things are getting interesting and heating up in the market. I can't wait to hear what they've got to say. We do want to say, though, there will be some financial topics presented today, but we're not giving any advice at all. We're not professionals in that field. If you have questions, you may want to speak with a financial advisor or a CPA or even an attorney if it applies to you and you need those services. Check someone out in your local area that can help. But we are the National Real Estate Investors Association. We're a nonprofit trade association that's been around for almost 35 years now. We have over 40,000 members across the U.S. and we're glad you're with us today. We appreciate your being here, and we want to also show our appreciation to the Home Depot Pro team because they have such a great relationship with us and do a lot of great things, including special programs just for us that include things like a discount at the register on paint of 20%. They've got a special rebate program just for us and other exclusive programs, including cabinets and appliance programs. So if you're interested in that, you will want to check out your local REIA so you can connect with them and join the programs there. If you're not already a member, you can come to the National REIA website and click on I'm an investor, and you'll see here why join or find a local REIA. You can get that information there, as well as any COVID-19 updates that we're having. And I'm hoping to not have this be here for very much longer. I'm hoping that goes away very soon. But yes, you can find your local REIA and find more information about the Home Depot program, as well as many others at your local group. So I'm going to now turn the floor over to Charles Tassell, let you hear about some of the quick legislative updates that we have, and then we'll get on with the main program.
Thank you, Rebecca. Welcome, everyone. It's going to be rather brief today. Just a couple of things I'm going to mention. On the outside, on the public side, the media side, there's write-ups about the tsunami of evictions. I'm sure you've seen some of that out there. The interesting thing, we talked about this behind the scenes and have reached out, even in the articles that are coming out, the fact that there's not a tsunami of evictions out there. What is interesting is they're also not talking about bankruptcies behind the scenes, foreclosures in business side of for small investors, or what we're really seeing is a number of small investors who are actually selling off property. We're hearing that's about 10%, and talking with brokers across the country, that's a number that's pretty consistent. About 10% of single family homes that were rental are being sold off and being converted over to single family homeowner. So that's going to have an impact. One of the pieces on that we are looking at is Affordable Homeownership Access Act. You might remember that as the seller finance bill previously. It has been reincorporated. Both Gonzalez and Cuellar have moved this forward, and there's actually going to be an event later this month up in DC. We'll be out there for it. I appreciate Jeff Watson working hard on that issue, but that's an issue. We're working on HR 5013, so expect to see more on that, and there will be a voter voice piece coming out on that. In the meantime, the thing that is eating up all the political capital in DC, and again, it is on the news headlines, you can't get away from it, whether it's Mansion or Cinema or chasing them into a bathroom, you can't get away from this stuff. So let me mention to you, right now, the can has basically been kicked down the road to early December. Government is functioning, the debt ceiling is raised, infrastructure bill sitting out there, human infrastructure bill, whatever number that actually becomes, most likely a reduced number. That number has been brought up to be 1.5 trillion rather than 3.5 trillion. And behind the scenes, there's pretty much a consensus that if it is only a 1.5 trillion human infrastructure bill, at that point, there's not going to be a need to offset it with tax increases, which would be a great relief for those of us who've been working on the self-directed IRA aspects of this and different rules. That would end up going away. Those would not have to be implemented. And if you are watching and kind of astute, everybody knows as we go into election years, things tend to get more and more polarized. Seems like they never get unpolarized in some sense. However, with presidential ratings kind of dropping a little bit, and what we're seeing now is Congress is seeing no reason to, especially the Republicans in Congress, seeing no reason to support the Democrats in Congress with their bills. There is a even more larger divide, and so the kicking the can down the road to December is really going to cause a bigger issue in December, where there's going to have to be some determination. And right now, the House and the Senate are really warring with each other, and it's House Democrats versus Senate Democrats to determine whether or not they're actually going to move bills forward, or if it's going to be, just my bill going forward, and maybe we get your bill forward in a different fashion. And so right now we're in literally gridlock, which for those of you who've had the benefit of being under new laws that get brought forward, gridlock is not always a bad thing. So let's see what happens. Again, we've got a little bit of breathing time. There will be a lot of maneuvering and moving, but even most recently as yesterday, Senator Sinema said she is not supportive of any new taxes. And again, as everybody knows, you have to have 50 senators plus the vice president in order to get something like that passed, let alone if you start talking beyond reconciliation and actually moving legislation forward that would at least have a 10-year window. You need to have 60 votes in the Senate. So that's what's out there. Let me shift from kind of the legislative side to the regulatory side. The administration has really been overwhelmed with a variety of issues. So whether it's Afghanistan, COVID, you name it, there's issues out there, and their appointees have not been going through the Senate. So there's a number of appointees in place. They have a variety of different titles, but they're not assistant secretaries and such. So regulations are coming out a little slow. You might have seen earlier this week, we put out a notice about 30-day notices. Those 30-day notices, if you are a subsidy provider or a housing provider that accepts Fed subsidies, so HUD subsidies, except housing choice vouchers, which they kind of excluded or said that they excluded, but we're still looking at some housing authorities and hearing that the public housing authorities are actually saying, well, we're going to include it anyways. So make sure you're paying attention to any new updates. If you are hearing anything from your housing authorities locally, what they're going to do with the housing choice voucher, if they're going to require 30-day notices because HUD is changing its rules. And that will go into effect on November 8th. Again, we've got an article already out on that and little updates on that. The last thing I'll say is we are still waiting to find out about a possible visit to DC in March. Again, that's typically when we go up, we have a number of visitors up, and you guys come in from around the country, and we have a really impactful time meeting with the legislators. Not sure if that's going to happen yet. So there's a lot of trade-off. As soon as I hear on that, I will be back to you on that. If we can do it, I would love to do it. And please, again, if you can make it, great. In the meantime, hang in there, especially as it comes to issues of rental assistance. I appreciate Illinois and there's a couple other states that have kind of shared with me some of their goods and the bads. Please share that information, keep it coming, because we share that up the chain, and also with our housing coalition members, and then again with Treasury and such. So if you've got best practices, somebody who's doing it right, let us know. If you've got people who are doing it wrong, please let us know. That's pretty much what I have, Rebecca. Mr. President, any questions?
No, I think that's pretty clear. Rebecca, we want to get started with our main guests today, Mr. Speed and Mr. Lauchner.
Yes, please. We're so honored to have them back again. There were just so many questions and so much information that we couldn't pack into the August meeting that we were excited to be able to have them back again. So I will not cut into their time by talking anymore. I will let them take it away and talk about the non-performing notes space.
Awesome. Well, thank you so much. And Ryan and Eddie, you can see my screen, correct?
Yes.
Yes, we can see your screen.
Perfect. Well, I'm very excited to kind of jump back on here, mainly because I really think that this is really the bigger picture. I know we alluded to that kind of last time about how, like, it's not just about, oh, how do we do this one thing? There's a bigger picture that we can be looking at. And as always, National REIA is trying to look at that bigger picture and kind of helping investors really dig down into it so they can take those next steps, ultimately really thrive in a market like this. I've got my good friend, Mr. Eddie Speed, with me here today. And for those of you who are kind of, let me kind of start where we, started last time. And then I really want to show you how we're going to change directions and really talk about finding deals, because this is consistently a problem in today's marketplace. Finding a solid deal is a concern for most investors. And it takes somebody like Eddie Speed, for those who don't know, 40 years of business, 50,000 deals. The guy, he knows a thing or two, right? And so it's one of those things of, let's really kind of find a unique way to look at the market and not just help you survive, but ultimately help you thrive. And today specifically, we're going to be talking about making money from bad debts, this non-performing loan space, and really what that might look like. I started the presentation last time really talking about this, right? The market beyond the mask, right? And now that we're in this almost different world to some extent, what are we supposed to do? How do we adapt, or do we die? Do we, that kind of stuff? And really to kind of let you know, I know it's only been a couple of months, but believe it or not, there's still some great things going on, right? Stock market's still going crazy, right? Residential real estate still doing well, low interest rates. Like we love these things, right? But as you know, the bigger part of the iceberg that isn't always addressed is really what we covered a little bit last time, right? FHA loans, a lot of them not paying, just residential loans in general struggling right now. A lot of renters behind. It's fascinating to hear Charles talk about 10% of these rental properties being sold off. These burnout landlords, if you've been following Eddie for a while, he's been talking about this for well over a year, getting close to 2 years now, of just these landlords who are just, it's a struggle right now, and they're desperate for some solutions, and so they're starting to get a little bit of a release valve, to release some of the pressure, but it's in the form of selling it off, not actually solving the real problem, which is what we talked about the last time. And so really, we're going to talk about all these mortgage issues that are going on, this mortgage crisis that we're in, and really what does it mean for us as investors? I'll just pop this up here for those of you who don't know a little bit about NoteSchool. We cover really the note business, but it's a lot bigger than just a note, right? And for those of you who don't know, a note is simply a promise to pay. Some party owes another party something, and that orange and that green triangle there, creative financing, seller financing, that's what we talked about last time. That's how I noticed creative, and we really provided some value on how to actually close more deals with a really unique strategy. So you can always go back and look at that. But specifically for today, now that loans and notes are created, what can you do with it, right? And you can wholesale a note. It's the paper side of real estate. You can wholesale the paper, not just the house, and you can buy and hold, of course. And really what we're going to be talking about today is that red triangle, that buying defaulted loans. And what is a defaulted loan or a non-performing loan? And really what this is these are mortgages that aren't being paid. And we're going to talk about what that looks like in today's marketplace and what does it mean specifically for you as the investor. And what I want you to kind of, if you needed a kind of a theme for non-performing loans, many of you have fixed and flipped homes before, right? You buy it, you fix it up, you add value to it, you create your own equity basically, and you make money for doing it, right? And this is more what it looks like to fix and flip the paper side of real estate, to fix and flip a mortgage. And I really want to show you why this is so important for you to know, and why it's important for you to know specifically right now here in the fourth quarter of 2021. Because obviously some things have changed in the last 18 months. And so that might mean we need to look at the market a little bit different. And so when we're looking at an asset, specifically a real estate note, right? You're going to promise to pay. If they don't pay, the house is collateral. They can come and take the house, right? I mean, unless there's a moratorium. A lot of us did not expect that one, see that one coming, right? But just to get everybody on the same page, when a mortgage isn't paying, it's just troubled, right? It's distressed, it's ugly, some might say, whatever it is. But much like a distressed or ugly home, you can fix and flip that. You obviously can rehab a note as well. And this is what's going to bring a lot of the value to it. And so what I want to show you is a couple of things to get everybody understanding why we think this is such a big deal. And then we're going to hear from our visionary, right? 40 years of experience. I can't even count the market cycles you've been through, Eddie, but really why we can take these details and what it means to us today. You're going to help us better understand that. But right now we're trying to do deals, and let's say you're buying them at 70 cents on the dollar, and that works, right? I'm not here to tell you quit what you're doing and do this new shiny thing. I'm trying to tell you that there's a market opportunity, and if you can buy assets and there's enough money in it for you to flip it or wholesale it or rent it, whatever you're going to do, keep doing that. But what I want to show you, I think that you're going to see, is this whole concept of non-performing loans is a way to enter these assets at a much lower rate, but through the paper side of the business. And you'll see that this might be really in good alignment with what some of your goals are. So I want everybody to understand how a non-performing loan works, because most of us don't. This is a relatively unknown thing, mainly because non-performing notes it's a piece of the market cycle, right? I've been saying that markets go in cycle, but for those of you like myself who've been in this for the last 10 years, I mean, it's not going to keep doing this another 10 years. Let's just put it that way, right? It eventually has to actually continue the cycle. And once it starts going that way, this is really kind of the section that non-performing loans becomes a really big conversation. 2018, 2019, Mr. Speed, this wasn't a big conversation in 2018, 19, was it? So I think
they weren't forced to sell the assets.
Yeah.
I mean, there was, before the virus started, Brian, there was about 500,000 defaulted loans. So there wasn't any. There was about 500,000 defaulted loans before the virus. And obviously then there became several million loans delinquent after the virus.
Yeah, absolutely. 4.5 million, actually, to be exact. And so if you are a note holder or you want to be a note holder, what does that mean? Why would I buy an asset if it's not cash flowing, right? Why would I buy an asset if I don't get paid? Isn't that why we got into this business? Is for the cash flow. And all I want you to understand is there's really only a couple things that you can do when someone stops paying a mortgage. And this is really where we're going to enter this space, right? You can modify it and get them repaying. We're going to talk about kind of what that looks like today. Or, maybe you can get them to deed you the property, or obviously we all understand foreclosure. And in the event that it's a modification, you're going to stay the bank. You're going to stay get them repaying basically, and you're going to keep that. But obviously in the event of these other two, you get the asset. And this is really what I think a lot of people think of when they think of non-performing loans, that you're in the foreclosure business. And while it is a part of it, I think Eddie will easily tell you it's not the goal, right? Non-performing is a way to not only get into assets at a much lower, price band, which reduces our risk, but also a way to help a lot of people get a second chance. And so now that everybody's kind of on the same page, I want to dig into some of these details here. And I really want to talk about this, right? Obviously, the market beyond the mask, yes, but where are the deals? And I was kind of sorting through some data. Eddie's got just an unbelievable team. His whole executive team really spends a lot of time researching and pulling data and trying to paint the picture, because I'll admit it, this can be kind of complicated when you know nothing about it. But it's amazing how just a little bit of conversation can get you up to speed very, very quickly. And so I literally pulled this up yesterday. This is the Federal Reserve data talking about listings. As you know, just by following national REIA, the number of listed assets are down, right? Really, really low. At one point, we were joking around about how there's a million listed properties, but there was 1.6 million agents or something. So somebody's not getting a commission check, right? Well, that number has been consistently going down. And really what I want you to see here is if there's less and less and less residential deals, doesn't that make our job harder? course it does. So where are the deals? And really what I want to talk about is the opportunities today. I said earlier, there's 4.5 million delinquent loans, and there's 1.1 million of those that are in a forbearance, and the rest you're just not paying. So think about this for a second. There's under 1 million assets that use residential or single family homes you could buy. There's 4.5 million, 3 to 4 times the amount of assets available in the non-performing space. And so just from a simplistic, if I'm looking for deals, where do I go? We're trying to flash the lights. We're trying to, sound the alarm and say, there's a lot of inventory that's available that you're just not looking at. On top of that, what probably doesn't surprise you is most people are not involved in the non-performing space, or really even in the note business. You just have a lot less competition. And so I want to take a second. I'd like for Eddie to kind of speak to really what's going on in this market cycle. And really, when you look at 4.5 million, non-performing assets, broken into about 1.1 of those is in forbearance. And if you'd like, you can kind of dig into that, but kind of show us the vision, really what you're talking about. And let's just take it one step at a time here.
Well, Rebecca, you and I had a great conversation a few months ago, really talking about, market voids. After 2008, the mortgage banking industry and the loan servicing industry, they came up with a name of trying to describe properties that weren't on the market yet, but were likely to become on the market in the future. And they called it shadow inventory. And Rebecca, I remember very well when we first started coming to national REIA groups and speaking on the subject of non-performing. I know you remember that well. And I did a lot of state of the industries for national REIA and stuff. And I can remember quoting numbers, Rebecca, there's 8 million delinquent loans, there's 10 million delinquent notes. And everybody literally that was involved in real estate at that time was fully aware of this incredible avalanche of delinquent loans. Literally everybody in real estate. In fact, everybody with a driver's license. Let me ask you guys a fair question. Unless you've been watching NoteSchool TV, it's not fair to ask you that if you've been watching NoteSchool TV, because we try to keep things up to date. But unless you've been watching NoteSchool TV, and Brian said there were 4.5 million loans that weren't paying, be honest, did you know that? Did you hear that on the news last week? No. We are living in a world of reality, but reality isn't being presented in front of us. I didn't even know about Let's Go Brandon until yesterday. I mean, seriously, I didn't even know that was a thing. Charles, I figured that lights you up a little bit. I didn't even know. I don't pay attention to that stuff because I've gotten to where I don't listen to them. But the truth of the matter is there's 4.5 million loans that aren't paying. And everybody says, Charles, oh, but don't worry. The government's going to forgive all their back payments and they're all going to be good. There's only 1.1 million loans that are available for that. Now, don't think that they're going to do 100%, like push all the payments to the backside, because you do have to qualify for a loan, right, Charles? Like a lot of the people that are in forbearance cannot qualify for a modification. They passed a law called Dodd-Frank that says you have to qualify. But we have millions of loans, not hundreds of thousands. We have millions of loans that are delinquent and not paying. Now, what's interesting is when I went to national REIA groups, Rebecca, in let's call it 2010, most of those loans, they owed $120,000 against the mortgage, and the property was worth 60 grand. The loans were excessively underwater. Everybody remember those days? So when you bought a delinquent loan, Brian, you had no choice. You had to not only push it through to foreclosure and pay all the taxes and keep it secured and keep the grass mowed and stuff, but you had to do this. The other problem was, Brian, that you then had to go take that property, probably blighted, and go sell it and go push it through to a market that really wasn't wanting to buy a house. Now, here's a wild market. The average loan that we see come through our student base and through our network, and we have a trade platform and we push loans out. So we are very involved with people that like aggregate non-performing notes down to an individual one-off basis. I would say we're the most active in the United States at that. The average cost of that loan is probably about $120,000 bucks. But Rebecca, the house is worth $280,000. These are equitable non-performing notes. So Brian, here's the cool part. You buy this loan and you pay $120,000 and the payoff on the loan is say $160,000. Now, when does the loan get paid off? At foreclosure or prior to foreclosure? Because if you're gonna bid it in at foreclosure, if we're gonna hire Jeff Watson to foreclose for us and you bid it in at $160,000, trust me, and if it's worth $280,000, somebody else is going to come buy that asset at the courthouse steps. It's an equitable defaulted loan. So this is a market era that since literally, as you said, Brian, I've been doing this 40 years. I've lived through 86 market. I've lived through 98 market. I lived through 2008 market. I've never seen it where we had a housing boom and a mortgage crisis.
That's it. And something else that I really want to make sure is clear too, for those of you who missed what he just said, is there's a time frame element, right? For those who understand time value of money, right? If it takes you 18 months to flip a house, or if it takes you 6 months to flip a house, chances are which one makes more money, right? Well, it's really no different in the note business as well. Is like he's saying, in these past markets, when they're underwater, you're getting this asset. You've got to go put more money into it. You've got to spend that time. There's not near as many buyers. Payday is farther out, right? Foreclosure on foreclosure.
And just less steps, and just less steps to go do.
Yeah. And I'm going to show you a case study actually that's very recent of what I think is a pretty unique deal, but it's also extremely common for today's marketplace. But the point is the time frame to your profit isn't near as long. And so as we kind of get it, I want to show you a couple of real world like articles that came out here recently to kind of focus on exactly what we're talking about. And I'll tie it into even what Eddie said. But this is Fannie Mae. They just came out with this, I don't even know what day it is, 3 days ago. I mean, this is really, really recent. And what this is saying is Fannie Mae is selling non-performing loans to buyers. That's what you got to understand. And Fannie Mae is not selling like one, right? Like there's lots of loans, 1.68 billion with a B dollars worth of loans, non-performing loans. Now, for those who are not as familiar with, kind of how the note space works, really kind of as a general rule, you could think of it like this. Banks will take non-performing loans and they'll push them off to the hedge funds. Hedge funds buy them at a big discount and they repackage them and they'll kind of sell them off, right? That's kind of the general rule of thumb for how this works. And so when we look at this, we don't just see, okay, look, there's a lot of non-performing loans selling right now. And yes, it's a lot of money. There's a couple of variables in here that are super important. And one of it ties to what Eddie's talking about, which is obviously the likelihood that they're going to get worked out or go to foreclosure or whatever. And the other one is actually has a lot to do associated with risk. And so when I go to this slide right here, what this is showing you is depending on the type of borrower, right? Owner occupied, someone lives in the home, right? Non-occupied, obviously. This is saying that 40% of owner occupied people avoided foreclosure in some way or another, right? Maybe they're in a forbearance program, they're going to get modified. They want to stay in the home, they can afford to stay in the home. But regardless of your desires, right, you can see what is that another 35% of people are teed up for foreclosure. And then look at all that, how big that black area is on the far right. That's another, 20-ish%, 25% that is not resolved. Now, what does not resolved mean? Well, that means no one's made a decision yet, which to us, for what we do, we solve a lot of these problems. So it's not just the ones that are going to foreclosure, it's all the ones that are not resolved. Typically in that space is where we sit as well. We're going to be the ones that step in, like I showed you before. We got to figure out the modification and all this kind of stuff, or end up foreclosing on them. But this is specifically for the Fannie Mae. And really what it just shows you is that it's not all It's not all rainbows and fairy dust right now, and everybody's going to make $1 billion and get all these assets. It shows you how complex really the market is right now, right? It's not, all right, everything's rolling over, it's all getting foreclosed on. No, some people, like Mr. Speed just said, they can't afford, but some people can't qualify. There's still people to this day that don't have either income, or they've taken a job that has a lesser income that no longer makes them qualified. And that complicates a lot of this. But obviously what you see is really in the vacant properties, this makes a little bit more sense too, that just a lot more of those are going to go to foreclosure. There's not the emotional ties or anything like that. And one of the things I want to tie into even what Charles said is where it says non-owner occupied, meaning that they're, a landlord or something like that. This crowd of people has been hurting, right? So really that whole that whole space right there, some of them have avoided foreclosure, some of them are qualified, some of them maybe they paid it off or got caught up or whatever, but a lot of them are still going to face foreclosure because tenants don't pay, which means they can't pay, and you get the idea. And there's still just so many to be resolved. And so as we kind of dig into this, really what I wanted to show you specifically for this is kind of tying it back into what Eddie said. 75% of the bids exceeded the UPB, but it was 50 to 70% of the value. Now, what that means is kind of interesting. The 50 to 70% of the value is really the important part, right? After 10 years of appreciation, when Eddie says that these are equitable foreclosures or equitable non-performing loans, it means that unlike in the past, right, where they are underwater, they've obviously gone up in value. And what that does for us as the note investor, this is what I'm trying to get to, is it reduces our risk substantially. And in a market that's essentially unstable, right, because there's not a standard growth or a predictable pattern, risk management becomes very important. And by buying an asset at, let's just say 50 cents on the dollar to keep it easy here, having that extra 50% equity is what hedges our money, right? And it really starts to drop the risk out of the sky. Now, what's really fascinating to show you how I've heard Eddie say we are in a deal-starved, yield-starved environment. This is saying they are paying 75% of those people looking to buy these assets exceeded the unpaid balance, which means if they owed 100 grand, the buyers are willing to pay 105 grand. Why would they do that? Because again, they're hedged on the other side. They're looking at it just from the value of the asset, knowing that worst case scenario, I might end up with this house. And if I end up with this house, I want to make sure I'm protected, right, Eddie?
Yeah, there's no doubt. This isn't even an inverse, because in most mortgage cycles that I've ever seen, no way that 25% of the time the lender would end up getting paid off. I mean, Rebecca, call it 10% of the time the lender got paid off for 2008 through 2016. Now, 75% of the time, whoever owns the delinquent note is getting paid off at foreclosure. Now, if you buy that loan at less than what's called the legal balance, then guess what happens? You made an investment and the loan that you own got paid off by some third party buying it at foreclosure. This is the most unbelievable market cycle in front of us for non-performing we've ever seen.
Yep. And I think what I want to do is I want to transition to show you a case study that's here recent. It's a couple months old. I just started working on it, but there was all these loans that were non-performing before the pandemic ever started. We call these legacy loans. And really all these pileup of loans when the pandemic started, there was the moratorium that halted those as well, right? And then obviously the numbers continued to grow. And what you got to understand is around this summertime, you were able to start buying some of these legacy loans. And just through my connections with NoteSchool, I was able to buy, a note from them. And what I want to, I haven't clicked the slide yet. Sorry about that. And so what I want to do is I really wanted to walk you through a case study to kind of show you how this looks specifically today. Because if you thought, like if you think, oh, short sales, foreclosures, that's where all the money's made, you're right. But you got to understand all this is done. All these decisions are made before we get to that point, right? So you're ahead of the people who are waiting on the short sales or want to negotiate the short sale, all the people waiting on the foreclosure auction, right? And so obviously a loan pays or it doesn't pay. We're going to talk about a pay. We're going to talk about a note that doesn't pay. And we're going to talk about how we're going to fix and flip that. And what does that mean to fix and flip a note? So anytime we look at a note, if you've ever attended, any of our training, I actually am teaching a one-day class, a deeper dive into a lot of this here coming up. If you want to attend, I show you that we start with the value of the asset first. And so when you look at an asset, we get a BPO or a valuation, right? This is a broker's price opinion. And really what they're going to do is they're going to throw out some numbers based on comps. And they think this one's worth about $240,000 if you can wait. Well, I can wait if I bought this note. But now that I understand the value, I need to know, okay, but what am I owed and what do I got to buy it for, right? And so the legal balance owed here is $102,000. That's what the person living in the home, if I buy this asset, they owe me that amount, regardless of what I pay for it. That's what they owe me, right? And they're 13 months delinquent. Now, just a little aside here about non-performing loans. Once you get in a pattern of not paying, the likelihood of you getting back on track becomes harder, right? Eddie, how long do you think someone goes without paying before it's like you're never going to get them back on track?
You get a customer 4 or 5 payments down, the likelihood of them just writing a check and bringing it current become very low.
Yeah.
By the way, just so you guys know this, these legacy loans, remember there's 500,000 of these. These legacy loans that were delinquent before the virus, they're not subject to any governmental, assistance like forbearance or anything like that. So these are loans that typically we work with a few, let's call them hedge funds that buy these loans in bulk, and they'll sell them like through our program, they'll sell them like on a one-off basis. But these are loans that typically, I would say more than 50% of these loans are already, the notice of default has been sent. They're already in foreclosure. The foreclosure date is already marked. And so you're buying these loans knowing that you're owed 102. Now, some of that is interest. It's not just principal. Some of that is interest. That's why we said the legal balance. But you didn't pay that for this loan, right?
I did not. Nope. I actually paid $79,000 and some change for it. So really what this means is that, again, let's look back at the scenario here, right? If I'm paying $80,000 for a loan, they owe me $102,000. This thing goes to a foreclosure auction. What market cycle are we in now compared to the past? We are in an equitable market. And so what that means is the values have gone up. Well, I told you that the assets now worth $240. Do you really think if this goes to foreclosure auction, someone's going to pay less than $102,000 for this thing? It's just highly unlikely, right? The chances of this getting sold for over 102 are substantially higher. Most importantly, though, from my standpoint, is what it says at the bottom. I'm at a 33% investment to value, meaning the money I have in it compared to its valuation, meaning worst case scenario, I got about 3 times as much of the asset to make sure I get my 80 grand back, right? And so I feel very hedged. I feel very protected. And really when we're looking at this, now you got to understand let me kind of walk you through what some of these things are. Because Eddie, one of the things I think that you'll point out here is that this is a tighter margin deal, right?
Well, I mean, you're thinking, I don't know. I'm buying a non-performing note and I'm paying 80 cents on the dollar. And let me make sure that everybody's clear about this. You bought this asset. Colonial did not buy this asset. You bought this. You trained for Colonial, but you have a sideline business. This is the deal you bought. But here's the thing. You bought it here, and foreclosure was set for 30 days out. Charles, would you invest 80,000 and get back 100 in 30 days? And your risk is you got 80,000 in a $250,000 asset?
All day, every day.
This is a market. This isn't a fluke deal, was what we're saying. He paid up for this deal and there's still a fortune in it. Now something happens to this deal, Brian, right?
It does. It's kind of interesting. So, and it's actually, you said 30 days because you're trying to be nice and you're using a generic term. But the reality is when I bought this note, it was a Wednesday. I funded it on a Friday and I kind of looked and I said, 80 cents on the dollar. Okay. But when's the auction set? Monday. And my thought was, if I buy it this week, I'll get paid $22,000 next week. And I just thought that's probably good enough. You know what I mean? That's what Eddie says. If you don't need a calculator to figure out the returns, probably good enough. And so I knew play one is, all right, great. chances are in this market, that's going to happen, but it didn't. Am I worried? No, I'm not worried. What happened next? On Monday morning, they filed bankruptcy. Now, Eddie, I'm going to go ahead and just confess here. I am definitely no bankruptcy expert. I'm not a bankruptcy attorney, but obviously NoteSchool connected me with a bankruptcy specialist, and helped me better understand really what that looks like. And from my perspective, it didn't really matter. All they're doing is they're kicking the can down the road, right? Isn't that what you say? And so I'll just go through all the steps, right? Okay, do we got to modify? They weren't qualified for a modification. Actually, in this case, they don't have income, which is obviously a problem. And so as I kind of move forward in the deal, right, I bought the deal. I thought, hey, maybe I'll make 22 grand next week. That'd be kind of nice. My risk is low, right? Most likely what's going to happen is it's going to go to auction and get paid off. But this bankruptcy kicked the can down the road. Actually, the auction that's set now that I've waited long enough is on the 28th of this month. So it'll actually go to auction here the end of this month. And chances are, being worth about 240, it's going to sell for more than what I'm owed, and I'm going to get paid off, right?
Well, Brian, here's the reality, right? Had they modified the loan under bankruptcy rules, they would have had to brought the loan current. Okay. Now this is a Chapter 7 bankruptcy. It wasn't a 13. They would have had to bring the loan current. Now, what's happened though is the legal balance was, call it $102,000. Okay. But the interest rate that is accruing on this note is not the interest rate that was written on the note when it was paying. It's the default interest rate. So the default interest rate, call it 15%. So the default rate is accruing and you're still making 15% per month or 15%, on a monthly basis, 15% per year. You're making that. All of your legal fees will 100% be paid off. So now the payoff, you had to hold it a little longer. So now the payoff, Brian, has increased. Call your payoff now increased another $4,000 or $5,000. So you had to hold it a little longer than you anticipated, but you're not losing money.
Yeah, and this is obviously the difference between.
You have a first mortgage on that property. Ask any bankruptcy lawyer in the country, and I'm not a lawyer, but I paid for a lot of them. You are a secured creditor.
Yeah, absolutely. And when we tie this back into kind of what you said, it's first of all, I don't mind waiting, right? When you're being compensated for it, obviously, kind of nicely, but also just the fuse for this thing to get to profit is just a matter of time. And to even mention what Eddie said a little bit earlier about the foreclosures, he mentioned it briefly. We didn't really talk about it, but he said a lot of times these foreclosures, they're already in process, right? Somebody's already started that. Well, when I saw that I could buy it this week and there was already an auction date set, it didn't get better than that, right? And so I viewed it as a quicker play, knowing that I got time, but obviously it kind of works out. Again, worst case scenario, really worst. Let's say nobody buys this thing at auction. It's just not going to happen. Okay, well, I end up with a house and I can list it with a real estate agent for 180 grand and probably sell it pretty quick. Or I could, you can use a lot of the seller financing techniques we talked about last time, create a whole nother note with a profitable person who gives me money down. And obviously then I would have a note. And then I could use all of the strategies that we already know, and that we spend a lot of time teaching to truly build wealth. But what's most important is a lot of people get all super excited about fixing and flipping, right? Like, yes, we love watching Chip and Joanna Gaines. Vanilla Ice was flipping houses for a while, so everybody can do it. We get it. It's sexy. You can make a show out of it. They're probably not going to make one out of non-performing loans, Eddie. I'm sorry. I know you were wanting it. I know that was a dream, but I don't think they're going to do it.
It's funny. They probably won't. And but I'll tell you something. I've had a lot of experience with real estate investors, and they get buying distressed assets. You just have to buy it at a price that says distressed. If you invested $80,000 in this note or 79, and you have all these things that can happen, you paid off, you make 25 grand, right? there's no way you're going to end up with it at foreclosure. I can just tell you that right now. The odds of that being would be ridiculous, right? But if you can go make 25 grand on this deal that quickly, and you didn't have to go do all of the work that somebody would have had to have done buying a non-performing note back in the old days. This is what I told you, Rebecca. This market is back. This hedge fund that owned this note bought $30 million worth of notes like this, and they're willing to sell them on a one-off basis through our platform. This isn't a fluke. This isn't a note. This is one hedge fund that made a trade, and this is one of the notes in that trade. This is just a sliver of the market.
Yeah, absolutely. And so it's kind of to pull the whole picture together, right? If you're really struggling to find deals, or you find competitions a lot, or just in general, where are the deals, right? I hope what you took away from today is really that there is this entire other market still in this space. You absolutely can still end up with the asset that is a part of it, but more likely with a lot less effort, you can fix and flip these notes. In this case, I didn't really have to do anything but just sit and wait, right? I didn't even have to pay for the foreclosure services. And so it's one of those things of, if I can get my money back quicker, or as Eddie would say, the fuse is shorter, so I can invest the money, get paid quicker. Now I can turn that capital over and do it over and over again. And unlike doing that with fixing and flipping houses, where the struggle is, I got to find another house. I'm out of business until I find another house. There's 4.5 million of these things just racking up, right? And the opportunity is available. And so I would tell you that if this is something you really want to learn a little bit more, I would really encourage you to just take the time to slow down and come learn step by step. Basically, this is one of the things that I get to do for Note School. I get to teach a class called Golden Notes, and it's a full day class where we talk about how really all this kind of comes together. Right. And we definitely talk about really what's happening in the marketplace today. I try to bring the most up-to-date, valuable information to the table for us to talk about how to do, not just creating our own notes. We'll definitely talk about a little bit of that, but specifically non-performing loans, because this is really the big part of the market right now. And in fact, just for showing up, Eddie wrote this book called Making Money from the Post Meltdown. This is all about making big money from bad debts, right? This really is what the entire book is about. It's great. You'll be able to get it literally for free just for showing up. It allows us to kind of slow down and go through kind of what this looks like, go through all these different niches and show you how there's a bigger picture here that can help equip you to become a better investor. And if you're wanting an opportunity to learn how to do it, this is a great way to do it. But also, if you're wanting an opportunity to get access to inventory, like the relationships I have are because of the relationships, that Eddie already has. You got to understand, this isn't like I'm brilliant, I figured it all out. Eddie, like his hunting buddy is a huge hedge fund manager. I mean, like we're talking about, he's got connections as well as he can teach you how to gain these connections. It's a much bigger picture than you can imagine. So I'd really encourage you to take some time. This is a full day class. It's $97 for literally the entire class. And it allows us to take some time to slow down, and it's really interactive. So bring your questions, bring your business problems, and really come learn and engage and figure out how this can fit in your business, and allow us to kind of chop up some real case studies to show you step by step how this can impact not just your business today, but truly impact your wealth, just because you know about it during this part of the market cycle. So go to noteschool.com/national REIA to get signed up for that. We've got one coming up here in just a few weeks that Note School's hosting. Anything else, Mr. Speed, before we do some Q&A?
No, this is a solid one-day class. It really talks about 3 voids in the market, right? We all can find it. We all know what the boom is in the market. Real estate investors make money because of voids. Real estate investors make money because of inefficient scenarios within a market. And so we talk about what those scenarios are. And last time we talked about burnout landlords, and we have a very specific strategy that we think is the most effective trigger that burnout landlords will sell and carry seller financing. It's a crazy thing, but they don't know about it until you tell them about it. So if you're like, this class would be worth it for that. But then non-performing notes, and then obviously leveraging strategies and stuff. So, Rebecca and I had a great conversation with Brian a few months ago, and I said, Rebecca, don't think because of this housing boom that notes have gone away. I said, it's just a matter of us doing a good job of realizing voids in the market and how to go take advantage of them. So, Brian, great job today as far as your great case study, and we'll look forward to you getting paid off, and maybe you can take us all to dinner or something. I don't know.
I don't, there's like 100 people on here. I don't know if I can take us all, but we can talk about it. We can talk about it. Well, thank you so much, Eddie, for taking some time. Really, I think it's very valuable to everyone on here, obviously, to be able to get that 40 years of experience and kind of a different view on the market. Without that, how are we supposed to know? So appreciate you taking some time. And Ryan, Rebecca, if you want, we could stick around for some Q&A if there's questions, and we'll kind of go from there.
Sounds good. Rebecca, do we have any questions?
No questions in the chat bar yet. I think most people are just going over to sign up now. Easiest way, of course, to get the full questions answered in more details. But guys, we just want to thank you so much for being here. When Eddie and I were talking, as he said, I was just blown away by the opportunity that exists in the market today for notes. It's something we haven't heard about. They're not talking about it on the news, which is a good thing, by the way, because by the time they do, the opportunity won't be there anymore, right? Isn't that the way it works? So, okay, so there is one question in the chat bar is, so if Colonial has all these deals, why are you not working them themselves? Why are you so able to be able to pass these off to the students? How did they get these kinds of goodies?
Just to clarify, I didn't buy this note from Colonial. I bought it from a hedge fund that has a relationship that Eddie developed. So this is kind of what I was trying to allude to a little bit earlier. Is it's not like, oh, Eddie's going to go buy all the notes so he can wholesale them to us, right? That's not the way Eddie does it, right? It's just been around too long. So he has some relationships that allows us to then have relationships, which allows us to do deals. And I don't know if you guys know this, but I don't know how much money Mr. Speed has, but you can't buy every note, can you? So, and there's preferences.
Well, it's the reality is this. I built NoteSchool 20 years ago to figure out how to do business with my students. I was saying hi to Kim Tucker, right? I've got tons of people on this call that have had a lot of experience with us doing business with them. So we are active in the space. We own a trade platform where we allow like a hedge fund to put these notes up there. We kind of vet the pricing to make sure that we think it fits the market. And then, Brian's right, but we have a fair amount of capital deployed on any given day. So we're in the space. But what we find, we're not going to, we said there's 500,000 legacy loans. We're not going to be able to buy all of those loans, but we feel like what we represent as a marketplace. And so the marketplace is, once we can put a student through a battery of training in NoteSchool, then there's just a lot of ways we can make money. And I've made a lot of business partners out of former students because we could do that. So it was my vision and my thought that with proper training, we could teach people how to go do the business and we all could prosper. And I kind of think that's what's happened.
Yep. And this seems like a little bit of a plug, but this is really the whole point of the one-day class is you got to come learn this stuff. I'll teach you where these things are and why it's so important for you to get involved, because I say it's not rocket science because my brother's an actual rocket scientist. And so I know I can't do what he does. So if I can figure it out, it obviously, it can't be too complicated, right? So.
Another question that I think we've gotten a couple times in different ways is how well capitalized does an investor need to be to enter the notes market? So how much money does someone have to be able to play in this game?
Well, we place a high focus on how to recapitalize your business. I mean, we understand that we show people opportunities, and then how do you do it? So, Brian, I don't remember, but I don't think you funded this with your money.
Yeah, my general rule in life is never use my own money. Eddie teaches a great strategy about working with a lot of these landlords who are just burned out, and really why they're the perfect source for funding right now. And what I found is I can raise longer term money that's also cheaper, and I can lower their risk instead of borrowing money to fix and flip a house where I'm paying 8 or 12%, and I'm fixing the house up and they're taking a much higher risk. I'm saying, let me use your money at a lower interest rate to buy a much lower risk asset, 33 cents on the dollar. And that obviously helps. And so I absolutely used 100% of someone else's money.
And of course, there's so much money in self-directed retirement accounts. I mean, I don't care which self-directed retirement account administrator you talk to, but they're sitting on probably an industry average about 30% of all their assets under management are sitting in cash, about 30%. So it's a gigantic number. And I work with a lot of IRA administration companies. I know this to be the case. And a lot of their people just don't know how to go find a deal. So if you're in the middle of the deal and you can do it, and there's some very easy, not complicated ways to paper it that are legal and aren't going to cause you to, get in trouble and be a rock star on Bigger Pockets and all that kind of stuff. So in a bad way.
Yeah.
And so that's what NoteSchool teaches. We want you to do the business and do it well. And you can, if you just follow the yellow brick road, so to speak.
Yeah.
And those are all topics you'll review in this session. Yes.
Yeah. I was actually going to say, so in the 1-day class in the morning, especially, I kind of talk about how really who the person is we're raising money from and why today it's a different conversation. 10 years ago, you'd say, I'll just give them more interest. They'll totally do it. People have been in this kind of market for 10 years. They're not trying to double their money again over the next 10 years. They're focused on 2 words, and that's capital preservation. All this money that they've made, they want to make sure they keep it. And when I'm offering something like, that's fine, put your money in a lower risk investment. Now, now all of a sudden I can start to turn some heads and have some conversations.
Speaking of lower risk, one other question is, because of Illinois' change in their length of time to foreclose, it's 13 months there. Is that maybe a state that people should stay out of when they're looking at these notes?
Well, it could be, but what if that house is vacant?
Yeah.
Because usually the special foreclosure laws are waived if the house is vacant. And you saw the line. The hedge fund that I just told you about that bought this $30 million trade, the guy that runs that hedge fund was sitting in my office right about the time he boarded some of those assets on Notes Direct, Brian, right about the time you bought that, right before you bought that asset, say it's two weeks before. And he said, Eddie, we ran vacancy checks on this portfolio and 60% of it was vacant. So once again, these are market conditions. Individual due diligence, Rebecca, absolutely could be the case. I'm not the first guy in the training business to say this, but I'm going to say it. Dispel your disbelief for a moment. Dispel why this can't work for a moment, because the truth of the matter is, what we're trying to point to you today is there is a market void that most of the world in real estate investing is completely unaware of. There is a gigantic opportunity. Now we're in the training business, and we're saying you're going to be way better off to do this with training than to go run an experiment without training, right? But we're saying that while a lot of people feel like they're getting their head beat in a little bit, trying to go find something at a discount, here is a huge inventory that can be bought at a what? At a discount.
Big discount. Yep. Absolutely.
2 other quick questions. On the platform, are the notes grouped in certain states, or are they all across the U.S.?
They're all across the U.S. Now, there's always a concentration. I would say we've always seen more of a concentration in, call it, probably 20 states. But, so the likelihood of finding a delinquent note in Hawaii on the platform is probably not very good, because, we don't have a lot of people that want Hawaii assets. Hedge funds that buy these assets buy bulk packages. They're not in one town, and they're generally not in one state, but there's enough variety there's enough assets that you're not going to have a
Yeah.
hard time finding something you can be comfortable with.
And then last one, I'm a new investor. Is this training for someone that has little knowledge about notes?
You know, I started Note School 20 years ago, Rebecca. You remember that. And I built Note School saying that if it wasn't good enough for my own kids, it wasn't good enough. Note School is the platform that I train my own kids, including one of my kids works with Brian on a daily basis, my youngest. And so it is, they started out with no real estate experience, and Note School was the platform that got them started. Now it's cool, as you know, Rebecca, we get to train some really advanced guys, and that's cool. And, you know, say you do that and stuff, but Note School is built to be from kindergarten to, you know, to graduate school. And yes, there's a place. I started in the business at 20 years old with my father-in-law. And I can tell you that I thought alone was being by myself. That's how clueless I was.
Okay, that's a good one. It's a dad joke almost, but it's a good one.
Yeah.
And you don't need to tell people that we've known each other for 20 years because that just makes me look old. But
Oh, but we have, haven't we?
yeah, we have. So guys, again, thank you so much. There's all kinds of thank yous coming in over the chat bar that you all can't see right now, but just wanted to let you know, thanks for being here again. Kind of surprised to hear what a great opportunity is right now, and excited to know that, because I think people are looking for those alternate strategies, and this is it. This is great. So thank you so much again for being here. We really appreciate you, and we will see you again in the Golden Notes class.
Sounds great.
Thanks, guys.
Thanks, guys.